balance sheet, some things naturally increase as my sales go up. So if you increase volume of activity in your business, you're going to naturally need, or you're going to have, more cash. How does that work? If my business is bigger, then I'm going to have more employees. I got more bills to pay. I've got more transactions to service, so I just need more cash in the bank. A small corner business needs less in the cash in the bank than does IBM, because IBM does more transactions around the world, so they just need more cash in the bank to handle all those transactions. A bigger business needs more cash in the bank. A bigger business is going to sell more on credit. Assuming, again, this is the key assumption, assuming that we're going to be bigger, but otherwise we're going to do business exactly the same as we did last year. If our sales are going to go up 20%, we're going to do everything the same as we did last year, but we'll do just 20% more of it. So if I had credit sales last year, this year when my sales go up 20%, I'm going to have 20% more credit sales. Just my whole business will have grown proportionately. Same thing with inventory. If my sales go up 20%, then I'm going to need 20% more inventory. I mean, I'm just a bigger business. I need more inventory sitting around because I'll have 20% more customers, 20% more people looking at stuff. I need 20% more inventory, assuming that I do things the same as I did last year. Now, you might be saying, well, what if I decide to change? Well, if you decide to change, that's another thing. That we know how to import that into the analysis. But in this first simple case that we're doing here, let's just assume that I'm going to do business exactly the same this year as I did last year, except I'll do more of it if I'm assuming that my sales are going to go up. Accounts payable. If my business goes up and I'm selling more stuff, I need more inventory, so I'm going to be buying more on credit, so my accounts payable are just going to go up naturally. They're just going to go up naturally. I don't have to make an explicit decision. You just do more business and follow the train of consequences through, and your accounts payable are going to go up, and you're going to have more inventory, and you're going to have more accounts receivable, and you're going to have more cash because you're a bigger business. Now let's talk about long-term planning. Your building, your machines, your equipment, they don't just grow organically, I like that word, in size just because your sales go up. My sales go up by 20%. My building says, oh, boy, I better grow by 20%. My warehouse, oh, I better grow by 20%. My machines, I better grow by 20%. No, that doesn't happen. If you're going to increase your sales by 20%, you have to sit down and say, okay, do I have surplus capacity now? Can I increase my sales by 20% given the stuff that I've got, or do I have to buy more? You're going to have a long-term capital expansion plan. It may very well be that we can manage a sales increase within certain limits by just using our existing property, plant, and equipment more efficiently. In other words, maybe I can make my sales go up by 20% without any new buildings or land or machinery or anything else. I just use more efficiently what I've already got. I've got some surplus capacity. Or it could be my sales are going to go up 20%, but I'm expecting a big sales ramp up in future years, so I want to build some extra capacity now. So maybe I'm going to expand my capacity by 100%. Yes, my sales next year are only going to go up by 20%, but I'm building for the future, because you don't just add a little bit to your building each year. You build big. You either build a new building or you don't build a new building. So I plan for the future. It's part of a long-term planning process. So the point is, sales increase by 20% doesn't mean that my property, plant, and equipment just automatically go up by 20%. There's more of a long-term planning process that's involved. Financing. So your banker hears through the grapevine that your sales are going to go up 20%. Does your banker just send you a check for more cash? Say, hey, I hear your sales are going up by 20%. You're going to need more financing. So here's a check. Your loans payable just went up by 20%. No, that's not how it happens. Financing is a choice. If I'm going to expand, am I going to finance that expansion through borrowing, through debt, through equity, or am I going to finance it through internally generated funds, through retained earnings? How am I going to do it? That's a strategic choice that I make. Is now the right time to get a new loan? Is now the right time to issue new shares? Is now the right time to look for new partners? Am I constrained by existing loan agreements? Maybe I've got a loan agreement with a bank now that says you can't borrow any new money, so I can't borrow the money to finance my expansion plans. What about my dividends? Am I going to pay out dividends? Am I not? Am I going to increase my dividends? All these are choices that need to be made. These don't happen automatically. As I plan my operating and capital expansion plans, I'm now going to have to figure out how to pay for all this, and those are choices that I need to make. They don't just happen naturally.